Hi everyone. Today I'm going to talk about how to earn a yield on your Bitcoin. If you've got a bunch of Bitcoin or other types of cryptocurrencies, you can earn a yield on them. And as an old Bitcoiner, I've been around for almost 10 years. I'm thinking about, okay, so I don't want to sell my Bitcoin. What can I do with them? You can earn a yield on them. Of course, earning a yield comes with risk, and there's a lot of different ways to do it, and that's what we're going to dive into. I'm going to go ahead and switch over to my other screen here. So this information, what you're seeing right now, this is my newsletter that comes out on Thursdays. Paid subscribers get this first. If you Google search the Held Report or click on this link right here, that'll take you to the subscription page where you get my thoughts first on Thursdays. All right, let's go ahead and dive in here. So gave a little bit of background on, I've been doing this for over a year and a half, and I share my monthly updates on Twitter. So if you don't already follow me on Twitter, go ahead and check me out. I'm Dan Held on Twitter. Every single month I provide a yield update where I walk through the different ways to earn a yield in my current calculations of my own portfolio. To be clear, I am not an advisor. I'm not a financial advisor. I am not a CPA. I am simply someone blogging my own experience. And if you find that interesting, great. So the yield spreadsheet, both of these, by the way, will be linked in the description. The yield spreadsheet represents, in one tab is my personal portfolio, the places that I've lent my own Bitcoin and how many coins I've lent out there. And then there is a tab for all of the other services. All of the other services show you different services, for example, in the lending or these different categories that I'll cover in a minute. Some of these I don't really advise, or I don't recommend personally. Again, I like to disclose exactly what I have versus others. Keep in mind too, I do receive a financial incentive if you use the links here or in the yield spreadsheet or in the yield tweet storm. These are called affiliate links. Just wanted to make sure I disclose that before going further. All right. So what risks are you taking? I like to cover risks in the beginning because we can always think about what can happen when it goes well, but what happens when things don't go well? Well, lending and borrowing was one of the oldest fundamental forms of finance. And when you lend out your Bitcoin, the reason why you're receiving interest is people are paying you for your time value of money plus compensation for risk. Risk isn't a good or bad thing. It's inherent for any sort of investment. You just need to think about what type of risk am I taking and can I tolerate that sort of risk? Some of this risk is really hard to nail down because, for example, when you lend your coins to some of these companies, you may not know some of the information that they do. A few other notes here before we dive into the different solutions. Contrary to traditional best practices, there may be no benefit to diversification across the different lenders in the space because we don't know if they all lend to the same counterparty. Also know that I really don't recommend using services that have a token. That token adds regulatory and structural risk. Note that these companies, for example, Celsius, they claim that they have the right sort of regulatory filing. From my understanding, they don't. They have a Form D, which is not the right form that they should be filing. I'm not a legal expert, but from my understanding, it is not at all, I would say, fully regulated. Then also, some of them claim to have an insurance policy that covers losses. That's completely false. For example, Nexo, they talk about how it's super secure. This number that they're compiling here is BitGo's insurance and Ledger's insurance, but that covers all of their customers, not Nexo customers. I think that's really disingenuous to have that number there, given the fact that that's not the actual amount that's being covered. And most people, and I've seen this on Twitter, a bunch of people ask me, hey, my stuff's insured, right? I'm like, no, so none of these services are insured. The reason why I don't like these token services, well, Cred was one with the token and they had some issues. Token adds regulatory, structural risk, and I also feel like some of them cut corners a little bit. So I'm personally not a fan of these. A lot of people ask me my opinion of those. That's why I put this in the beginning, and that's why I put it in the risks section. All right, let's go ahead and jump into the traditional finance lending platforms. This is the most common way to earn a yield on your Bitcoin. You've got services like Ledn. Ledn is a great service. They're really about transparency. They've got a proof of reserves standard where they're actually the only one to actually demonstrate proof of reserves with an auditor. I think that's really cool. There's a lot of nuance on if a proof of reserves is actually meaningful or not. I encourage you to look more into this. Nick Carter on Twitter has some great thoughts. So Ledn's a great service that I personally use. Then there's also BlockFi, Genesis Capital, and others. I'm just going to cover a few here because we don't have a ton of time to cover every single one. But the basics of lending out your Bitcoin is that you lend Bitcoin to them. They then go lend that out to other folks, kind of like a Bitcoin bank, if you will. Now, the yield that you can expect from these services would be 3 to 6%. And the type of risk is known. You know that the type of risk you're taking is known, but what you don't know is who they've lent these coins out to. And there is also custodial risk. For example, the folks who they lent the coin out to getting hacked, or the service themselves getting hacked. Liquidity, this is one of the most liquid options in the market. You can move millions or tens of millions into and out of these services with relative ease. Most of them do have a 24 to 48 hour withdrawal delay. I personally like that. If I ever got hacked, I know at least I've got 24 to 48 hours. Some people find that uncomfortable, or some people sign up and then find that surprising. It's not surprising. It's just a safety mechanism. Some exchanges like BitMEX, for example, have the same sort of protocol set up. All right, so how do you do it? You sign up for an account. I recommend Ledn or BlockFi. I have my funds at both of those. The link for that's here. You deposit Bitcoin and start earning a yield immediately, which is really, really sweet. All right, the second type of earning a yield on your Bitcoin is through margin pools. Exchanges have margin pools that allow folks to go long or short a certain crypto asset, and they need to borrow that asset. And this is the rate that people pay to borrow that asset. On these exchanges, for example, like Bitfinex, Bitfinex has their funding rate available here that you can view on their website. So if you go check it out, you can go check out what the current annualized yield is. This rate changes by the minute, so it's really hard to predict what this rate might be. Right now the annualized yield is around 1.46% when I pulled this a few days ago, but it can be much higher. As you see, this is the daily funding rate. These rates can be much, much higher depending on the demand to borrow Bitcoin with these folks who are going on margin. So yield, kind of a wild range between 1 and 10%. This risk, though, I think is really, really cool because you know your counterparty. You know who you're lending the coins to. So it's, do I trust Bitfinex? Do I trust another exchange that has this margin pool? Do I trust their ability to manage their risk? That's what you're thinking about. Now, there are circumstances where things have gone bust. With Poloniex, they had a margin pool malfunction where their risk engine didn't catch it properly, and they lost $13 million, which they socialized amongst the different people who had lynched their coin. So this is not without risk. There are examples of people losing their principal. However, I do think this risk is much more well known, and given exchanges will become more sophisticated over time and likely have big cash buffers. Poloniex, when this happened, didn't have much money, and so they weren't able to plug the hole. Some exchanges, I think like Binance has previously plugged a hole that existed because of a hack. So if the exchange has a ton of money, it's likely that they'll compensate people even if there's a failure in their risk engine. Liquidity, you can enter and exit in reasonable size, low millions, probably spread out over time. With Bitfinex, you can go look at their open order book and go check it out yourself. They even have a lending pro function where you're able to think about how to lend in a much more sophisticated manner, or create like sort of a bot that'll automate it for you. Ease of use, anyone can do it. They can click deposit, sign up, and start earning a yield. And then how to do it, you can sign up for an account at Bitfinex, deposit Bitcoin, and put your order there. All right, now to covered calls. Covered calls are a little bit interesting because most people, when they think of options, they think of like a whiteboard with a bunch of crazy calculus math going on. It's actually a little bit simpler than that with this type of option in particular. Okay, so again, these are all linked to in my yield spreadsheet. You can go check out what I currently have, where my money currently is. You can check out where I've mapped out the space, and then I've got my own sort of matrix of different aspects of these services. So, what are covered calls? It's an option. It's an options trade, so it's an option where the owner of the underlying asset, so I hold and own Bitcoin. That's why it's called covered. They sell their upside above a certain price, and that price is called the strike. And then in compensation for that, they receive a premium. So, for example, I could sell a $100,000 covered call. I own Bitcoin, I sell a $100,000 covered call. The buyer of the option pays me a premium. What they're paying me for is that covered call at the strike price, so the $100,000. We look at a certain expiration. So let's say June 25th, 2021. They compensate me for the right to purchase Bitcoin from me at $100,000 of Bitcoin at that date if Bitcoin is over $100,000 of Bitcoin. So what happens here is in late June, If Bitcoin is below $100,000 of Bitcoin, as the seller of that option, I keep my Bitcoin and I keep the premium. You keep the premium no matter what. Now, in the scenario where the option gets exercised, so let's say by the end of June, Bitcoin's above $100,000, I keep the premium and then I have to sell my Bitcoin to the buyer of the option for $100,000 of Bitcoin, no matter how high the price has gone. So you're selling your upside past a certain strike or a certain price is the way to think about it. And people are paying you for that convenience or that option. The yield that you earn here is dependent on how close you are to the current price, how far away the expiration is. But the TLDR is the yield is basically correlated to the likeliness of the event occurring. You can sell a covered call at the current price and people are going to pay you a lot more for that privilege because it's very likely that Bitcoin will be above the current price at a future date. And so that's the way to think about it, is that yield is this sliding bar of less yield but less likely scenario, higher yield, more likely scenario, I think is the easiest way to put it. There's a lot more complexity here around implied volatility, options pricing, a bunch of crazy stuff. That's where you get into the wild math. But the core fundamental part of a covered call strategy is, are you comfortable selling your Bitcoin at this price? And I think that's a really cool strategy. We're going to get into the yield side here. But I think it's a really cool strategy too if you have to sell your Bitcoin. For example, let's say your life partner wants to buy a home and he or she may not care about Bitcoin long term, and you love them and you want to preserve your relationship. So you've already mentally gone, okay, I'm okay selling my Bitcoin. If you're going to do that, you might as well sell a covered call at the current price. And I'll show you why here in a second. So what does this look like with some real numbers? Now, I pulled these on March 18th. Again, it's a market, so the prices are constantly moving. Note that annualized is a bit of a misnomer, as you don't know what the yield will be next time you sell calls. So I'm taking the yield on these calls and annualizing the number. We technically don't know what the environment, the options pricing will be once this June 25th expiration ends. Therefore, I can't predict comfortably the annualized yield, but this just gives you a projection on if things all remain static. All right. So these are real numbers pulled from LedgerX. I think Deribit and LedgerX are both great solutions. Deribit is much more liquid. LedgerX is US CFTC regulated. So it depends on where you live, depends on what you're looking for. So these are real numbers here. If you currently, as of March 18th, $60,000 strike equals around a $12,000 premium for the expiration of June 25th. So what you're doing here is you are selling your upside past $60,000 by June 25th. So if at June 25th, Bitcoin is above 60K, they can buy Bitcoin from you at 60K no matter how high it goes. They're paying you $12,000 per Bitcoin for that privilege, which is a 61% annualized premium. That's where these get really wild, is if you get the closer you get to the current price, the crazier these premiums get. These premiums are also a function of volatility, which Bitcoin is very, very volatile. So if you're going to sell your Bitcoin, you really don't want to, but you have to. You can sell a covered call far in the future at the current strike. Or at the current price, you were going to sell anyways, but this one you earn the premium, and the premium's so high that maybe that's enough money to cover whatever you needed to buy to begin with, and you cross your fingers that it's not above that price at the expiration, which you're selling at the money. It's very likely that it will be exercised, but you were going to sell your Bitcoin anyways. Now let's look a little farther out. So we've got June 25th, $100,000 strike. You still get an 18% annualized premium. I mean, that's pretty juicy. And the further you get out, because you can go out to $200,000, $300,000 covered calls, those get very, very small, like 2 to 5%. But then that's starting to be competitive with these other solutions like lending to Ledn or BlockFi. And that's where I think things get really interesting. And it's to each their own on if you're willing to sell your Bitcoin at that price, right? I mean, there's the other counterparty buying it. You both perceive that event being low. That's why the interest rate's lower the farther out we go, or the yield is farther out we go, because we go, well, this event is less and less likely. But maybe that's a pretty cool strategy to, when you do this, to earn a yield. So the yield here is between 1 and 80%. It depends on how far away the strike is, volatility, all these other factors. The TLDR, the yield is somewhat equivalent to how likely this event will occur. what's really cool is that you can take your premium, because you get the premium in a lump sum immediately. It's not like, unlike these other solutions where they pay you monthly, this you get a lump sum. So that technically means that your yield is actually higher because you could go reinvest that lump sum, etc. But I think that's really cool. And with that premium that you receive by selling this covered call, you can move that anywhere you want. You don't have to keep it there. So I think it's a really cool way to think about managing your coin and earning yield. The type of risk is phenomenal. You understand exactly what the risk you're taking. There technically is no counterparty risk. There's only custodial risk. You just have to hope that the exchange custodies your Bitcoin for the duration, all the way till expiration. They custody your Bitcoin properly, and that they're not going to get hacked. There's no counterparty risk because for some of these exchanges, they're 100% collateralized, and you don't have to worry about someone else fulfilling their obligation because they've already fulfilled one half of it. They're just holding your Bitcoin there just in case the price goes over the strike. Liquidity is decent. So with Deribit, so Deribit's got, I think, the most liquid. The Deribit is the most liquid market out there. And by the way, here's Deribit, and you can look at all of their. You can run these numbers yourself for different strikes and different expirations. They've got the different dates here, the different expirations, and then they have the different strikes. They've got strikes that go all the way up to $400,000 of Bitcoin. And then LedgerX here, I've logged into my account. You can look at this as well in terms of the different options, the different prices, and the depth of the order book. This is where things get a little bit funky. You're going to notice these are Bitcoin minis. So 100 equals 1 Bitcoin. These aren't super liquid. It's kind of complex and kind of a whole different, whole crazy kind of deep dive on why that exists. I think some of this is that options pricing is really, really complicated and there's not too many market makers in the space. But you've got a decent chance of getting filled in the 6-figure range if you go put these limit orders in and show that you're willing to sell your Bitcoin or sell this call at a certain price. There's not a ton of liquidity in terms of like if you want to be a taker and take liquidity resting on the order book. There's not as many orders resting there as spot trading. So how to do it? You can sign up with Deribit. You get 10% off trading fees with that link, and then you can fund your account with Bitcoin and sell a covered call. All right, last but not least, decentralized finance. So DeFi is a popular sort of narrative in this space. There are some Bitcoin-esque DeFi solutions. The first one is CoinJoins or Join Market. So CoinJoins allow Bitcoiners to obfuscate their coins by mixing them with other Bitcoiners. So in order to create a market of folks who want to mix right now and folks willing to mix, the folks who want to mix right now pay the ones who are willing to mix a fee for that convenience. The yield for this is super low. CoinJoins are extremely low risk. It's been operating for 5 years. It's sort of a DeFi-esque solution, and the yield is approximately, it's under 1%. It's really hard to calculate and totally depends on a bunch of different factors. And the types of risk, keep in mind that in some countries this activity might be considered unsavory, but overall I think it's a really cool way to earn money on your coins, very low risk. And you get the added benefit of making them more and more private. Liquidity is a little bit tricky here. I think if you're trying to earn sums on earn yield on sums larger than $1 million, you're probably gonna have a tough time consistently because you have to continually mix them in order to earn this yield. So it's about your mix efficiency. And then ease of use is on the harder end of the spectrum. You have to know how to do command line. Here's a website that walks you through how to run a yield generator with the software. So for the folks who are a little bit more technical, that might be an interesting way for you to something for you to check out. Lightning Pool is really cool. It's simply an order book for Lightning liquidity, which I think is really, really fun. Here kind of demonstrates how shallow this market is. These are block numbers, and then you have the bid and asks and clearing. The source are linked here, but yeah, essentially it's super liquid at the moment. What I think is really cool, though, is that this is another very low-risk solution, and you're helping out Bitcoin while you do it because you're enabling people to use Lightning more effectively. GitUmbrel is a great software that recently added this sort of functionality around Lightning Pool. So they developed a GUI meaning an interface that us non-technical people can use to do this. They're also, I think, the best software to run your Bitcoin node. Great interface, really easy to use. They're awesome. So check them out. Here's their announcement about Lightning Pool. So they've got a great solution for that. And here's a visualization of how that looks. So they've got a great visualization for it. Hopefully it becomes more and more liquid because when it does, I think this is a great way for Bitcoiners to earn yield on their coin. So I already covered all that here. Instructions, you can install Umbrel on your hardware device of choice, and that's what this is linked to, and then run Lightning Pool. Okay, last but not least, Stacks. So Stacks, I had a few of my paid newsletter subscribers reach out and ask me my thought on Stacks. It's a smart contract platform on top of Bitcoin. To be clear, Stacks is a token. It is not Bitcoin, but you can earn a Bitcoin yield by staking your Stacks tokens. Currently, those are around 13% a year. So let's see. Start stacking. I forget they have a yield calculator here. Let's see, earnings calculator. Yeah, it's around 13% right now for stacking Stacks or stacking Bitcoin with Stacks. It is very different than every other solution I provided here. All the other ones were earning a yield on your Bitcoin. This is earning a yield in Bitcoin. Again, Stacks is another token. I'm a Bitcoiner only sort of guy, so I'm not recommending this. I had some people ask me about it, and someone donated $500 so I could try it out and then talk about it here. So, which I'm going to donate or give to someone else. But yeah, so people like it because you're earning a Bitcoin yield, and that's why I felt it was appropriate to cover it here. So you essentially stake your Bitcoin, and you stake your Stacks, and you earn a Bitcoin yield. It could take a few days to a few weeks, depending on how many Stacks you have to start the process. If you have under a certain amount, you can't do it yourself. You have to go with a pool that pools the Stacks together. It's an interesting way to do it. I think everything else is more applicable for folks as it's earning a yield on your Bitcoin, whereas this would require you to buy a token, and I don't feel comfortable recommending that. People should own Bitcoin. All right. Well, I hope everyone enjoyed this. It should be, I think, this is something I'm going to try to build out into like a way that is updated every single month. As I mentioned before, I already do this, but I think I'm going to make it a little bit more robust, where I'm going to add more visualizations. Maybe I'll get historical rates. Hope you enjoyed. If you liked it, throw me a like, throw me a subscribe. Thank you. Cheers.